You have $100,000 right now. One choice gets you $235,000 in 10 years. The other, $291,000. But here's the twist that nobody talks about. The winner might actually be the wrong choice for you. This isn't just about which number is bigger. This is about your time, your stress levels, and the life you'll live for the next decade. I'm going to show you the actual math, the real costs that influencers conveniently forget to mention, and why the answer depends on three critical factors that have nothing to do with which asset class performs better on paper. Quick favor. Hit like and subscribe right now so YouTube shows this to more people who need to see it. Let's meet our contestants. In Corner A, we have ETF Investing, specifically the Vanguard Total Stock Market ETF. This is the passive wealth builder. Buy it, forget it, live your life. In Corner B, we have Real Estate, the leveraged appreciation play that promises cash flow and tax advantages but demands your attention every single week. Now, here's what makes this interesting. I'm going to show you three different real estate scenarios based on actual market conditions, because the same property investment can either make you money every month or cost you money every month depending on when you buy. Let's talk about leverage, because this is real estate's secret weapon and the reason it can outperform ETFs. When you put your $100,000 into VTI, you control exactly $100,000 of assets. Simple. But when you put that same $100,000 into real estate as a 20% down payment, you now control a $500,000 property through a $400,000 mortgage. This is 5 times leverage. Here's why that matters. When that property appreciates by just 3.5% annually, you're not making 3.5% on your investment. You're making 12.6% on your actual cash invested. That modest appreciation gets amplified 5 times because you're capturing gains on the bank's money, not just yours. But leverage is a double-edged sword, and this is critical to understand. It magnifies losses just as powerfully as it magnifies gains. There's something else happening too that most people overlook. Mortgage paydown. Over 10 years, your mortgage balance drops from $400,000 to roughly $337,000. That's $63,000 in principal you've paid down. And here's the beautiful part. Your tenant paid it through their rent. This is wealth building happening automatically in the background. Now let's talk about the 3 market scenarios, because this is where context becomes everything. Scenario A represents current 2025 reality. Mortgage rates are 6.23%. You're buying a $500,000 property, and monthly rent is $4,200. Sounds good, right? Here's the problem. Your monthly costs are $4,112. You're losing $79 every single month. You're not making money. You're subsidizing this investment, betting entirely on appreciation to bail you out. This is the hard truth nobody mentions when they're trying to sell you real estate courses. Scenario B is a better market. 5.5% mortgage rates, a $450,000 property. Now you're generating positive $355 monthly cash flow. This is the sweet spot where you get cash flow and appreciation working together. Scenario C is ideal conditions. 5% rates, $400,000 property, strong $435 monthly cash flow. This is the dream scenario. But here's the catch. You need the right timing and the right market to access it. The critical insight that changes everything. Location and market timing matter more than asset class. In 2021, with 3% mortgage rates and rising rents, real estate crushed ETFs. In 2025, with 6.23% rates and stagnant rents, ETFs are more attractive. The market cycle you're entering matters just as much as which investment you choose. Let's break down what real estate actually costs, because this is where the fantasy collides with reality. In year 1, before you've made a single dollar in appreciation, you're spending $64,139. Property tax eats $6,000 annually. Insurance takes $2,500 and it's rising 10 to 15% every year. Maintenance reserves require $5,000 minimum, and that's if nothing major breaks. Property management costs $4,032 per year at 8% of rent. Vacancy loss averages $2,520 annually. Utilities and miscellaneous expenses add $1,800. Your total operating expenses, $21,852 every year. That's 43% of your gross rental income consumed by operating costs before you've paid a single dollar toward your mortgage. Here's the maintenance trap that destroys new investors. You budget $50 to $100 monthly for repairs, feeling responsible and prepared. Then the roof fails. $15,000. The HVAC system dies in summer, $8,000. A pipe bursts and floods the basement, $5,000. These aren't hypothetical scenarios. These are normal expenses that happen to every property eventually, and they hit you all at once, destroying your cash flow projections for the entire year. Compare that to ETF costs. Your total 10-year cost for owning VTI? $300. The expense ratio is 0.03% annually, which equals $30 per year. Zero management fees, zero maintenance costs, zero tenant drama, zero emergency repair calls at 2 a.m. Property management fees alone for real estate exceed 13 years of VTI ownership costs. Let that sink in. Here are your 10-year results. ETFs delivered $234,868 after tax value with 8.91% annualized returns. Real estate scenario, A delivers $291,100 at 12.6% returns, but you've subsidized it with $9,440 in negative cash flow over the decade. Scenario B gives you $276,000 at 12.01% returns with $42,629 in positive cash flow. Scenario C delivers $258,275 at 11.28% with $52,144 in positive cash flow. Now let's talk about taxes, because this is where real estate has a massive hidden advantage. With ETFs, tax treatment is straightforward but limited. You pay 15% long-term capital gains tax when you sell. Your 10-year tax bill, $23,800. No deductions, no strategies, no complexity. You make money, you pay taxes, done. Real estate tax strategies are a completely different game. First, depreciation. You can deduct $14,545 annually on your $500,000 property. At 24% tax bracket, that's $3,491 saved every year. Over 10 years, $34,910 in tax savings. This is essentially free money through tax law. Second, the 1031 exchange, and this is the wealth compounding secret that sophisticated investors use. When you sell your property for $705,299 in year 10, you'd normally owe $77,424 in taxes. Instead, you identify a replacement property within 45 days, complete the purchase within 180 days, and defer those taxes indefinitely. Do this multiple times over your lifetime, building wealth tax-free. When you die, your heirs receive stepped-up basis. That tax is never paid. Let's compare the tax math directly. ETF total tax burden, $23,800 paid. Real estate with 1031 exchange, $0 paid. Taxes deferred indefinitely. Real estate depreciation benefit over 10 years, $34,910. Net tax difference, $58,710 advantage to real estate if you execute the strategies correctly. But we need to talk about risk, because this is where your sleep quality and stress levels enter the equation. ETFs give you diversification across 3,600 stocks spanning the entire U.S. market. Market volatility means 15 to 20% annual swings in normal years, minus 35% in severe downturns like 2008. But you get daily liquidity and zero operational risk. No tenant calls, no maintenance emergencies, no management headaches. The downside? Zero control. You're along for the market's ride whether you like it or not. Real estate risk is concentrated and operational. All your capital sits in one property, one location, one building. Tenant risk means difficult tenants, eviction costs, extended vacancies that kill your cash flow. Major repairs hit hard and concentrated. Liquidity risk means 6 to 8 months to sell in normal markets, longer in downturns. And leverage risk cuts both ways. A 10% S&P 500 decline costs you $25,868 on your ETF portfolio. That same 10% property decline combined with a vacancy, your property drops to $450,000, potentially underwater on your mortgage. In 2008, leveraged real estate investors lost everything. ETF investors who held recovered fully. So who should choose what? Choose ETFs if you work full-time with limited free time, need instant liquidity, feel uncomfortable with negative monthly cash flow, are uncertain about your local market, want to add money regularly through monthly contributions, prefer simplicity and low stress, or want to start small with even one share. Expected outcome: 8 to 10% annualized returns, 1 to 2 hours per year time commitment, low stress. Choose real estate if you can dedicate 3 to 5 hours weekly to management, have deep local market knowledge, can handle negative cash flow for 3 to 5 years, are comfortable with 6 to 8 month exit timelines, want to maximize tax deductions, have 100,000 plus to deploy as lump sum, are in a market with either low rates or strong rents, and understand concentrated risk. Expected outcome: 11 to 13% returns in favorable markets, 3 to 5 hours weekly commitment, moderate to high stress. But here's the smart money move: the hybrid strategy. Put 60% into ETFs. That's $60,000 providing passive wealth building, diversification, and instant liquidity. Put 40% into real estate. That's a $40,000 down payment capturing leverage benefits, tax deductions, and cash flow optionality. This split uses your time efficiently because most wealth comes from passive investments, captures leverage benefits from real estate, maintains liquidity with $60,000 instantly available, optimizes taxes with 40% generating depreciation deductions, and reduces concentration risk. Combined expected return: 9.5 to 10.5% with superior risk-adjusted returns. Here's the verdict: if you're in current market conditions with 6.23% rates and tight rentals, ETFs likely outperform on a risk-adjusted basis. Real estate still wins on raw returns at 12.6% versus 8.91%, but you're subsidizing negative cash flow. If you're in a favorable market with 5% rates and strong rents, real estate clearly outperforms with positive cash flow immediately plus leverage benefits. If you're uncertain or prefer hands-off, ETFs win decisively. Sometimes the best investment is the one that doesn't keep you up at night. If you want to maximize lifetime wealth, the hybrid approach wins by capturing benefits of both with 1031 exchanges providing tax-deferred compounding. Neither ETFs nor real estate are universally better. Success depends on 3 critical factors: your local market conditions including rates and rents and prices, your time availability for active management, and your tax situation and ability to use strategies like 1031 exchanges. The same $100,000 grows to $235,000 or $291,000 depending not just on asset class but on market conditions, your effort level, and your tax strategy sophistication. There's no one-size-fits-all answer, but there is a right answer for your specific situation. So which team are you on? Team ETF or Team Real Estate? Maybe you're going hybrid. Let me know in the comments below. If you found this valuable, smash that like button and subscribe so you don't miss the next deep dive. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching.